Usually when we talk about a corporate earnings report, there's this expectation of total precision.
Right, like it's a science or something.
Exactly. It's treated like engineering.
Yeah.
You look at the spreadsheet, and the revenue line shows a specific trajectory.
And the analyst just points at the cell and says, there it is. That's the reality of the business.
Yeah, it's supposed to be binary. You hit the target, or you completely miss it. Up or down.
Clean and visible.
Right, perfectly categorized on a balance sheet. But then you step into the world of airline economics.
Oh, man, yeah. That's where things get wild.
Yeah, suddenly that spreadsheet is just incredibly murky. I mean, you are basically trying to read the altimeter while the plane is flying through a hurricane.
That's a great way to put it, actually, because you're factoring in, volatile commodity prices.
And shifting consumer behavior.
Yeah, and complete foundational overhauls of legacy business models.
Which brings us to today. Welcome to a Talk Tickers Deep Dive. We're unpacking the official earnings call transcript for Southwest Airlines.
Ticker symbol LUV.
That's right, LUV. And we're looking at the second quarter of 2026 here.
Which was a massive quarter for them.
Huge. We are breaking down the direct words of CEO Bob Jordan, Chief Operating Officer Andrew Watterson, Chief Commercial Officer Justin Jones, and CFO Tom Doxey.
And the main story here is that Southwest Airlines just posted record-breaking revenues.
Yeah, after completely changing their business model over the last year.
Right. And the market is just staring at these numbers right now.
Trying to figure out if this is like a one-off stroke of luck in a travel-hungry world.
Or if Southwest permanently upgraded their core earnings engine.
Exactly. Because, the airline industry is notoriously brutal, right?
Oh, it's massively capital intensive.
Yeah.
And it is highly, highly sensitive to fuel shocks.
And brand loyalty is famously fickle.
Yeah, so when a carrier with a 50-year entrenched culture attempts to rewrite its own commercial DNA, the stakes are existential.
They aren't just tweaking the margins here.
No, they are trying to prove that a massive pivot in their strategy is fundamentally working.
And looking at the Q2 data, the magnitude of the shift is just undeniable.
Completely undeniable.
So I was reading through the transcript and I zeroed in on the adjusted EPS, the earnings per share.
Right. Which came in at 94 cents.
94 cents. For anyone holding LUV right now, that is up a staggering 120% year over year.
It's a massive jump. They completely blew past their own initial guidance.
And the consensus of the street, yeah. But okay, as an investor, I always look at a 120% EPS jump with a healthy dose of skepticism.
Sure, you have to.
Because financial engineering, specifically, aggressive share repurchases.
Right, buybacks.
Yeah, buybacks can artificially inflate EPS by shrinking the denominator, even if the underlying business is stagnant.
That happens all the time.
Right. So my immediate question when I see that is this just a buyback mirage, or is the actual commercial operation driving this?
Well, I can tell you it is entirely operationally driven.
Really? Entirely.
Well, yeah, to validate that 94 cents, you just have to look at the top line. Adjusted operating revenues hit $8.7 billion.
Wow. $8.7 billion.
Yeah, that is a 20.3% increase year over year.
That's crazy.
We are talking about the highest quarterly revenue in the entire history of Southwest Airlines.
Okay. Yeah, that proves it.
Right, because share buybacks might manipulate the bottom line per share, but you cannot fake $8.7 billion in raw customer cash coming through the door.
No, you definitely can't. $8.7 billion in a single quarter is just a massive print.
It really is.
But, the metric that really dictates the health of an airline is RASM, right? Revenue per available seat mile.
Exactly. RASM is the true yielding power of the airline's real estate.
So Southwest's adjusted unit revenues jumped 20.1% year over year.
And remember, management had guided for 16.5 to 18.5%.
Right. They crushed the high end of their own wildly optimistic guidance.
Absolutely demolish it.
But here is the data point that literally stopped me in my tracks.
Okay.
They achieved this massive 20.3% revenue growth on essentially flat capacity.
Right, yeah.
Capacity grew by only 0.2%. Let's break down the mechanics of that for a second.
Okay, let's do it.
They made 20% more money flying basically the exact same number of planes.
Flying the exact same routes, yeah.
I think about it like a delivery driver doing the exact same route they did last year.
Right.
They don't take on any new neighborhoods. They don't buy a new van. But somehow, at the end of the day, they are bringing home 20% more cash.
That's a good analogy.
But if I'm looking at that business, I'm assuming they are price gouging their customers to the point of imminent churn, right?
Right.
I mean, how does an airline extract 20% more yield from a fixed asset base without utterly destroying their customer goodwill?
So the delivery driver analogy works on a micro level, but at scale, Southwest isn't just charging a higher flat fee for the exact same service.
Okay, so what are they doing?
They fundamentally changed the nature of the cargo. Wall Street analysts refer to this as idiosyncratic earnings.
Idiosyncratic. Break that down for me.
Sure. So in this sector, when demand is hot and revenues rise across the board, it's usually just a fuel recovery story.
Meaning what?
Meaning gas goes up, every single airline raises base fares, and the consumer just absorbs it because they have literally no other choice.
Right, because everyone raised their prices at the same time.
Exactly. That is a macroeconomic tide lifting all boats.
Okay.
But Southwest's 20% jump on flat capacity is entirely idiosyncratic. It's unique to them.
Because of the structural changes.
Right. They overhauled their yield management systems to completely segment their pricing structure.
So they didn't just raise the floor?
No, they built a much higher ceiling by introducing new fare families, and they basically forced a trade-up dynamic.
Okay, we'll definitely get to the specifics of that trade-up dynamic, especially the bag fees in a minute.
We have to talk about the bag fees.
But I want to stick to the cost side of this equation first, because the margin profile here makes absolutely no sense to me.
It's pretty wild, yeah.
Their adjusted operating margin hit 6.7%, which is like a 3.3-point improvement.
Yep.
But they achieved this margin expansion while absorbing a nearly $900 million year-over-year increase in second quarter fuel expenses.
It's incredible.
I mean, fuel is an airline's largest uncontrollable operating expense.
Without a doubt.
$1 billion exogenous shock to the ledger usually drags operating margins straight into the red. It dictates bankruptcies.
It absolutely can, yeah.
So how in the world did they expand margins by 330 basis points while eating a $900 million fuel penalty?
Well, it really just demonstrates the absolute leverage they've built into their new commercial model.
Leverage how?
When an airline faces a $900 million fuel headwind, their traditional response is to either slash capacity.
Grounding planes.
Right, grounding older, less fuel-efficient planes.
Yeah.
Or they aggressively hike base fares, which usually destroys demand and lowers load factors.
Right, people stop flying.
Exactly. But Southwest managed to hold capacity flat, eat the commodity cost, and outpace the expense with pure structural revenue generation.
Wow. So the new revenue streams are just that powerful.
They are. The new revenue streams they've activated have such incredibly high flow through to the bottom line that they acted as a shock absorber for the fuel market.
A shock absorber for a $900 million hit. That's insane. Which I guess brings us to the ROIC. The return on invested capital.
Oh, yes, the ROIC.
The transcript highlighted it reached 9% after tax. And Tom Doxey, the CFO, he hammered this point.
He really did.
He explicitly stated it was a major milestone moving beyond their weighted cost of capital, or WACC.
Right, the WACC.
And we know that if a company's ROIC doesn't exceed its WACC, it is functionally destroying value with every single dollar it spends.
Exactly. You're losing money by spending money.
Right. And with interest rates where they are in 2026, the cost of debt is not cheap.
No, it is not.
So what does this 9% spread actually tell us about the efficiency of their capital deployment?
Well, it tells us that the capital allocation framework is finally working in tandem with the commercial strategy.
Okay, meaning?
Meaning, in a high interest rate environment, the hurdle rate for value creation is punishingly high.
Right.
And Southwest has poured billions into fleet modernization, terminal upgrades, and completely overhauling their back-end IT.
To support the new fare structures, yeah.
Right. If they were only yielding a 5% or 6% ROIC, the market would penalize them heavily for misallocating capital.
Because they wouldn't be clearing that hurdle.
Exactly. But hitting a 9% after-tax ROIC confirms that these massive structural investments are actually generating surplus economic rent.
Wow.
They aren't just treading water, they're actively expanding the economic moat of the firm.
Okay, so the financial foundation is throwing off massive yields despite macro headwinds.
Yeah, it's remarkably strong.
That kind of forces us to look at the actual operational levers they pulled on the ground to force these numbers up.
We have to talk about the elephant in the room.
Yes, the execution of the bag fee.
What's the biggest story?
I mean, for over 50 years, Southwest's entire brand identity, their ultimate sacred cow, was bags fly free.
It was practically a religion for them.
It really was. But in 2025, they finally caved and implemented bag fees for their basic economy tiers.
Yep.
And according to this Q2 2026 call, That single initiative is now generating a run rate of approximately $1 billion a year.
$1 billion in high-margin ancillary revenue, just from bags.
But my concern is the psychological toll here.
What do you mean?
I mean, they slapped fees on a customer base that chose them specifically to avoid those fees.
Right, that was the whole pitch.
I would have expected a massive churn event, like a mass exodus of their core demographic to Spirit or Frontier.
Sure, that was the fear.
But the loyalty numbers in the transcript contradict that entirely.
Completely.
Rapid Rewards, their frequent flyer program, saw new member enrollments increase by 35% year over year.
35%?
They were pushing 100 million members now. And Chase co-branded credit card acquisitions are up 28%.
Those numbers are huge.
Are consumers just that captive, or is there like a deeper behavioral economics play happening here?
Oh, it is a profound lesson in behavioral economics and sticky pricing power.
Okay, break that down.
So Southwest didn't just ambush their customers with a hidden fee at the checkout screen.
Right.
They presented a highly structured, segmented choice. Justin Jones pointed this out on the call.
Right, the chief commercial officer.
Exactly. He noted that they introduced a stripped-down basic economy fare that includes the bag fee, but they heavily incentivized the sell-up.
The sell-up.
Yes. They framed the traditional Southwest experience, 2 free bags, boarding priority, complete flexibility, as a premium tier.
Ah, I see.
And consumers are highly logical economic actors in the aggregate. They did the math.
And what did the math tell them?
They realized that even with the new fare structure, the overall value proposition of Southwest's network still far outweighed the legacy carriers.
Because of the sheer density of their nonstop flights.
That and the lack of punitive change fees, it's still a better deal.
Okay, so they essentially anchored the consumer to the cheap, stripped-down fare, making the premium tier look like a massive value add rather than a penalty.
Precisely. It's brilliant framing.
And clearly, it's driving engagement, because a 35% jump in Rapid Rewards enrollments isn't just passive acceptance, it's active participation.
Oh, absolutely. And those Chase credit card numbers you mentioned, up 28%, are arguably the most important metric on the page.
You think so?
Oh, for sure. We know that modern airlines are essentially just massive credit card companies that happen to fly planes.
Right. The planes are just a loss leader for the credit card points.
Essentially, yeah. Those co-branded cards generate high-margin recurring revenue that flows straight to the bottom line.
And it's completely insulated from the price of jet fuel.
Exactly. The credit card portfolio is the ultimate hedge.
How does that actually work mechanically?
Well, when a customer acquires a Chase co-branded card, they are effectively locking themselves into the Southwest ecosystem for years.
Because they want to earn the points.
Right. So the lifetime value of that customer skyrockets. The airline sells miles to Chase at a massive premium.
Okay.
Then Chase awards them to the consumer for their daily spending, and Southwest recognizes that revenue with almost zero marginal cost.
So a 28% increase in card acquisitions in a single quarter is a staggering acceleration of their most profitable business unit.
Staggering. It proves the brand equity wasn't tied exclusively to free bags. It was tied to the overall utility of the network.
Let's pivot to that network utility, actually, because it's not just the leisure travelers signing up for credit cards.
Nope.
The transcript noted that managed business revenues corporate travel grew 30% year over year.
Hitting an all-time quarterly record, by the way.
30% growth in managed corporate travel is absurd for an airline that historically catered almost exclusively to the family vacation.
It really is.
I mean, legacy carriers like Delta and United have spent decades building impenetrable fortresses around the corporate travel market.
Oh yeah, with aggressive volume discounting, massive global networks, and premium airport lounges.
Right. So if I'm a corporate travel manager at a Fortune 500 company, my GDS, my global distribution system, is hardwired into the legacy carriers.
Definitely.
How is Southwest breaking into that oligopoly and stealing a 30% growth share?
By weaponizing their point-to-point network against the legacy hub-and-spoke models.
Okay, explain the difference there for someone who might not be familiar.
Sure. So legacy carriers rely on funneling passengers through massive hubs. Think Atlanta for Delta or Chicago for United.
Yeah, you always have a layover.
Exactly. That works well for international travel, but if you are a domestic sales rep who needs to fly from Nashville to Austin or San Jose to Burbank,
flying through a legacy hub adds hours of unnecessary layovers to your trip.
Hours. And Southwest operates the most dense point-to-point domestic network in the country.
They just fly straight there.
Right. They hold the #1 market share position in nearly half of the 50 largest U.S. airports.
Wow, half.
Yeah. So for a massive segment of domestic corporate travel, Southwest simply offers the fastest, most direct route.
But speed alone hasn't been enough historically, right? I mean, they've always had point-to-point. What changed recently?
They finally modernized their commercial distribution.
What does that mean?
For years, Southwest refused to integrate fully into the major GDS platforms that corporate travel managers use.
Oh, they wanted everyone to book directly on southwest.com.
Exactly. And it was a massive point of friction for corporate travel managers.
I can imagine having to go outside their normal system just for one airline.
Right. But over the last 2 years, they finally capitulated. They upgraded their technology to interface seamlessly with corporate booking tools like Concur.
Oh, wow. So they just removed the friction.
Yes. Once the corporate managers could easily see the Southwest point-to-point schedules right next to the legacy hub-and-spoke schedules, the time savings became totally obvious.
That makes perfect sense.
Furthermore, as Justin Jones highlighted on the call, these corporate travelers are not buying the basic economy fares.
Right. They are mandated by their companies to buy fully refundable, highly flexible premium fares.
Exactly. And this flood of high-yielding corporate bookings directly drives that 20.1% RSM explosion we discussed earlier.
Okay, that definitely connects the dots. They remove the IT bottleneck and let the network gravity do the work.
That's a great way to summarize it.
But, growing revenues aggressively often means letting operational costs run hot.
True.
If you are servicing 30% more corporate clients and handling the logistics of segmented fare classes, your back-end costs usually bloat.
Usually, yes.
But Tom Doxey addressed CASMX, which is cost per available seat mile excluding fuel.
Right. It's the raw metric for how lean the airline is running.
He reported it increased just 3.4% year over year.
Which is incredible.
I mean, in a macro environment where labor contracts are compounding and inflation is still sticky, holding unit costs to 3.4% is really tight.
Very tight.
He also mentioned keeping non-frontline headcount dollars flat to 2025. They are scaling the revenue footprint without adding middle management.
And that flat non-frontline headcount is a massive structural advantage.
Because legacy carriers have so much bloat.
Oh yeah, legacy carriers often suffer from massive corporate bloat when they expand their commercial offerings. Southwest is forcing automation and demanding cross-departmental efficiency instead.
But I'm guessing that's not the only thing keeping CSMX low.
No, the real driver of that low CSMX number is their aggressive fleet modernization and divestment strategy.
Ah, right.
Doxey spent significant time on the call detailing the retirement of over 450 older Boeing 737 NGs over the next decade.
Right, and he made a very specific point that they're selling these older planes at a premium.
Yes.
As an investor, I understand depreciating assets.
Right.
But why is an airline booking substantial gains on the sale of decades-old aluminum tubes?
It comes down to the mechanics of the secondary aviation market and engine maintenance reserves.
Okay, walk me through that.
Well, Southwest operates a uniform fleet of 737s, right? And their maintenance protocols are arguably the most rigorous in the entire industry.
Sure.
Over the lifespan of a 737 NG, the fuselage obviously loses value. But the CFM56 engines retain massive intrinsic value.
The engines hold their value.
Oh yeah. There is a massive global shortage of these specific engines and their spare parts.
Interesting.
So leasing companies and secondary market operators in emerging economies will buy a 20-year-old Southwest 737 NG well above its book value solely to pare it down.
Just to harvest the engines and avionics.
Exactly. And because Southwest depreciates their airframes aggressively on their balance sheet, when they execute these divestments at inflated market prices, they recognize a significant cash gain.
That is fascinating. The parts are literally worth more than the plane.
Yep. Doxey explicitly stated this fleet divestment strategy drove about a full point of CSMX improvement in the quarter.
Wow. It is a highly sophisticated, durable cost offset mechanism.
It really is.
So they are arbitraging their own depreciation schedule.
They are.
But they're also arbitraging geography, particularly with fuel.
Oh, this part of the call was amazing.
We know they took a $900 million hit. But Doxey mentioned they actively mitigated even higher costs by shifting lower-priced Gulf Coast fuel to the West Coast.
Right.
How does an airline execute geographical arbitrage on jet fuel? It's not like they can just load up a fleet of tanker trucks and drive them down Interstate 10.
No, obviously not. The logistics of jet fuel procurement are incredibly complex.
I bet.
It all revolves around pipeline capacity and regional refining crack spreads.
Crack spreads.
Yeah, crack spreads. The west coast of the United States is essentially an energy island.
Meaning?
It has limited local refining capacity and super strict environmental regulations, which means the spot price for jet fuel in California is often significantly higher than in the Gulf Coast, where refining capacity is just massive.
Okay, that makes sense.
The price differential between these two markets is called the crack spread.
Got it.
And Southwest's fuel procurement desk monitors these spreads constantly.
Like day traders.
Literally. When the spread widens to a specific threshold, Southwest utilizes their massive balance sheet to purchase bulk fuel at the Gulf Coast refineries.
And then how do they move it?
They secure space on interregional pipelines, or they even charter maritime shipping to physically transport the fuel to their tank farms at West Coast airports.
Wait, they charter ships?
Yeah. The logistical cost of moving the fuel is entirely offset by the massive discount they secured at the Gulf refinery.
That is a masterclass in supply chain leverage.
Truly. Most airlines simply pay the local spot price and pass the cost to the consumer.
Right.
Southwest actively trades the commodity logistics to defend their margins.
So they are basically operating a highly sophisticated commodities trading desk, masquerading as an airline procurement department.
That's a very accurate way to describe it.
That explains the margin defense. But, all this financial engineering and logistical brilliance doesn't really matter if the core product deteriorates.
Exactly. The operation has to run smoothly.
Let's look at the actual ground operations. COO Andrew Watterson stated they ranked #1 among large domestic carriers in completion factor.
Meaning they canceled fewer flights than anyone else.
Right. But he also admitted to significant friction on the tarmac.
He did.
He specifically called out delays in the last 10 minutes of the turn times.
The turn times.
And the turn time is the lifeblood of Southwest, right? Their historical dominance was built on the 10-minute turn, flipping a plane faster than anyone else to maximize asset utilization.
It's what made them famous.
So if the last 10 minutes are bottlenecking, that kind of breaks the model.
Yeah.
What is actually causing that friction?
It is the direct physical consequence of their new commercial strategy.
The bags.
Yes, the bags. Historically, with bags fly free, passengers checked their luggage, meaning they walked onto the plane basically empty-handed and sat down immediately.
Right. Boarding was incredibly fast.
Now, with the introduction of bag fees for the basic economy tier, consumer behavior has aggressively shifted.
Naturally.
Passengers are maximizing their carry-on allowance to avoid the fee entirely.
So everyone brings a roller bag.
Exactly. When you have 175 passengers all trying to cram oversized rollaboard suitcases into the overhead bins, the physical geometry of the aircraft cabin becomes a massive bottleneck.
I've seen it happen. The boarding process just grinds to a halt in the aisle.
It's a game of Tetris that delays the pushback.
It really is.
Yeah.
Even if Southwest's fee structure allows for carry-ons, the consumer psychology has been permanently anchored by the rest of the industry to fight for bin space.
Precisely. And while the completion factor is fantastic, I mean, they are getting the planes to their destinations, these cumulative 10-minute delays drag down their on-time performance metrics.
And it decreases the daily utilization rate of the aircraft.
Right. And Watterson was remarkably transparent about this on the call.
What did he say?
He noted they are actively re-engineering the ground operations. They're testing new boarding zone configurations and bin loading procedures to claw back those minutes before the high-volume holiday travel season.
So it's basically the operational tax they are paying for the new revenue streams.
That's a perfect way to put it. It's a tax.
But they are investing heavily in the in-cabin experience to offset that friction.
Right.
They highlighted the rollout of Starlink Wi-Fi across the fleet.
Which is a huge upgrade.
High-speed, low-latency internet is a massive product enhancement, especially considering they are aggressively targeting that 30% growth in corporate travelers.
Absolutely. If you are a business traveler, the lack of reliable connectivity on older Southwest flights was a total deal breaker.
Right. Starlink completely removes that final objection.
It neutralizes one of the legacy carriers' final competitive advantages. Corporate travelers demand seamless productivity.
And by standardizing high-speed connectivity, Southwest ensures that their product offering matches the expectations of the high-yielding demographic they are actively acquiring.
Spot on.
All right, so we've dissected the quarter. The structural overhaul is just massive.
It's incredibly dense.
We've got bag fees generating $1 billion run rate, corporate travel exploding, credit card acquisitions surging, ruthless cost control via fleet divestment, geographical fuel arbitrage, and managing the physics of crowded cabins.
It's a lot to take in.
But in the market, past performance is just prologue, right? We have to look at the future.
Always.
Let's look at the management guidance, because this is where the earnings call transcript got genuinely tense.
The Q&A was intense, yeah.
Wall Street analysts are basically genetically programmed to look for the absolute peak of a cycle and call the top.
Oh, they love calling the top.
They are looking for any sign of deceleration.
And the analyst Q&A is always a battle of narratives, right?
Yeah.
And the narrative Wall Street tried to force on this call was that the bag fee momentum was already dying.
Exactly. Let's look at the numbers. Management guided for Q3 RASM unit revenues to grow between 17.5% and 19.5% year over year.
Which is still huge.
Right, 19.5% top-line growth for a mature airline is phenomenal.
Unheard of, really.
But the analysts immediately pounced. They looked at Q2's 20.1% growth, looked at the Q3 guide of 19.5%, and cried deceleration.
They always do.
And I'm looking at this mathematically, and if I see the growth rate dropping from 20% to 17%, I have to ask, is the initial hype of the commercial pivot fading? Is the consumer tapping out?
Well, no.
Tell me why I shouldn't interpret a lower growth percentage as a bearish signal.
Because interpreting that as a bearish signal fundamentally misunderstands the mathematics of base effects.
Base effects, okay.
Or what analysts call the compillusion.
The compillusion, explain that.
You have to look at the denominator of the equation. In Q2 of 2025, Southwest had not yet fully rolled out the bag fees or the basic economy segmentation.
Oh.
The revenue baseline was historically low. So when Q2 2026 printed these massive new revenues, they were comparing a highly optimized, high-yielding model against an old, inefficient model.
Right.
That massive delta creates the 20.1% growth figure.
Right. It's easy to show massive percentage growth when your starting point was artificially depressed.
Exactly. But as we move into Q3 of 2026, the comparison period changes.
How so?
In Q3 of 2025, Southwest had already begun implementing the new fare families. The revenue baseline for Q3 2025 was already significantly higher than Q2.
Okay, I see where this is going.
Therefore, guiding for 17.5% to 19.5% growth on top of an already elevated optimized baseline is actually an acceleration of absolute revenue dollars.
This is a mathematical headwind, not a demand headwind.
Precisely. Bob Jordan pushed back incredibly hard on the analysts for this exact reason.
I look at it like this. If I launch a new product and go from $1 million in sales to $2 million, that's 100% growth. Amazing.
Great year.
The next year, I go from 2 million to 3 million. That's only 50% growth.
Right.
And Wall Street analysts will downgrade the stock because my growth decelerated from 100% to 50%, completely ignoring the fact that I just added another $1 million in hard cash to the top line.
Yep. They get blinded by the percentage change and totally miss the absolute magnitude of the cash flow.
That is exactly the dynamic playing out here.
And to definitively kill the deceleration narrative, management offered a critical real-time data point regarding forward bookings.
What was it?
They noted that Q3 yields, the actual ticket prices consumers are paying right now for future travel, are currently running up 24% year over year at this point in the booking curve.
24%.
Yes. For context, at this exact same point in the Q2 booking curve, yields were only up 13%.
Wow, that is the kill shot to the bear thesis right there.
It really is.
The actual cash they are collecting per ticket is accelerating drastically, from 13% up to 24%.
Exactly. The blended RASM percentage might look slightly smaller purely due to the baseline math, but the raw pricing power is strengthening.
The consumer is not tapping out. They are aggressively prioritizing travel and actively choosing to pay Southwest's new premium pricing tiers.
It proves the structural changes are sticky. The demand curve is inelastic to the new fee structure.
That is a massive insight. But, the guidance wasn't universally flawless.
No, there was a bump.
The bears definitely latched on to the full-year EPS update.
Yeah, they did.
Previously, management guided the street to expect at least $4 per share for the full year.
Right.
But on this call, they officially adjusted that range down to 3.25 to 4.25.
They widened and lowered it.
Yeah. And if I'm a retail investor holding the stock and management just lowered the floor of their earnings guidance by 75 cents, my immediate instinct is to hit the sell button.
Naturally.
A lowered floor is almost universally a downgrade. Why is this EPS revision not a massive red flag for the core business?
Because context is everything in financial modeling. Tom Doxey meticulously broke down the components of that revised EPS, and it is crucial to isolate the operational performance from exogenous macro factors.
Okay, separate the business from the environment.
Right. The core commercial business, the bag fees, the corporate travel, the credit cards, is actually outperforming their internal models.
So if the business is doing better, why the downgrade?
The downward revision to the EPS floor is entirely driven by two massive external variables related to the commodity markets.
Gotcha.
First, it bakes in the forward fuel curve as of July 17th, which was highly volatile and trending upward.
Okay, the future price of fuel.
And second, and more importantly, it accounts for a staggering $1.33 per share year-to-date fuel headwind that they have already absorbed on the balance sheet.
Wait. I need to make sure I'm doing the math right on that. A $1.33 per share fuel headwind.
Yes.
So if the global oil markets had simply remained flat year over year and fuel prices hadn't spiked, their operational performance would have driven their EPS well over $5 per share.
Yes, absolutely.
That's incredible.
When you strip out the exogenous shock of jet fuel pricing, which, again, is completely outside of management's control, the industrial and commercial execution of the airline is generating massive earnings growth.
Wow.
The revised 3.25 to 4.25 guide is simply an intellectually honest reflection of the macroeconomic reality of the energy sector.
It is not a failure of the transformation strategy.
Not at all. In fact, the only reason the EPS floor is still above $3 is because the new commercial revenue streams are so robust that they're absorbing a billion-dollar commodity shock without breaking the model.
That distinction is just vital for investors to understand. The core engine is running hotter than ever. They are just flying into a massive geopolitical headwind.
Exactly.
Now, let's look at how they plan to deploy their assets into the back half of the year.
Capacity planning.
Right. We discussed capacity earlier. They guided Q3 capacity to be essentially flat, maybe down 1%.
Yep.
But Q4 capacity is guided to grow by 4.5%.
Right, a significant bump.
Going back to my delivery driver analogy, they're finally putting more vans on the road in the fourth quarter.
They are.
But Justin Jones made a very specific, deliberate point about where those vans are going.
He did, yeah.
He stated, this capacity growth will be deployed exclusively into points of strength. What does that mean strategically for an airline network?
Well, in airline network planning, when you take delivery of new aircraft and increase capacity, you face a binary choice.
Okay.
You can either attempt to open entirely new routes, say flying between two tertiary cities where you have zero historical brand presence, hoping to stimulate new demand.
Like trying to open a new market from scratch.
Right. That is highly speculative, incredibly risky, and those routes often bleed cash for years before turning a profit.
And what's the alternative?
Or you can take those new planes and add frequencies to routes where you already dominate the market.
The points of strength.
Yes. Southwest is choosing absolute discipline.
So they aren't expanding the map.
No, they're taking that 4.5% capacity growth and pouring it directly into their fortress markets.
Right, because they have the #1 market share in nearly half of the 50 largest U.S. airports.
Exactly. By adding more flights throughout the day in these specific cities, they make their schedule even more attractive to the high-yielding corporate traveler we talked about earlier.
I see. If you are a business traveler in Dallas or Chicago, and Southwest adds 3 more daily frequencies to your destination, they become the undeniable default choice based purely on schedule convenience.
It's all about frequency.
It's the difference between doubling down on your best performing, highest margin franchise locations versus trying to open a brand new store in an untested neighborhood.
Exactly. It reinforces their existing monopolies.
It creates an impenetrable moat. They're using their capacity growth to build thicker walls around their most profitable customers, rather than chasing vanity growth metrics in unproven geographies.
That's a perfect summary.
Which brings us perfectly to the ultimate question. We've thrown a massive amount of data, historical context, and mechanical analysis at this earnings call.
A lot of numbers today.
But on Talk Tickers, we promise actionable takeaways for the listener.
Always.
Is this a bullish or bearish signal? What is the definitive thesis for the retail investor holding or eyeing LUV stock?
Well, let's synthesize this. CEO Bob Jordan spent a significant portion of his opening remarks outlining why competitors simply cannot copy their new playbook.
Right. He called it an unreplicable moat.
And his argument is fundamentally sound from a structural standpoint.
What makes it unreplicable?
An economic moat is a durable competitive advantage that protects a company's long-term profits from being eroded by competitors. Jordan outlined the 4 pillars of Southwest's specific moat.
Let's hear them.
First, they operate the largest domestic network in the United States. You cannot build that overnight. It requires decades of hoarding gate leases, landing slots, and terminal real estate.
The infrastructure is just too massive to copy.
Exactly. Second, they offer the most non-stop domestic flights, which is the singular most important variable for the high-margin business traveler.
Right, no layovers.
Third, that dominant #1 position in nearly half of the top 50 U.S. airports creates insurmountable network gravity.
The points of strength we just talked about.
Yes. And fourth, their unmatched hospitality and brand equity, which is consistently validated by external metrics like their J.D. Power rankings.
So if I'm a retail investor looking at this, Southwest just successfully performed open heart surgery on their entire commercial model.
They really did.
They slaughtered their sacred cow by implementing bag fees. They completely overhauled their IT to corporate travel. They navigated a $1 billion fuel shock, and the operation didn't collapse.
In fact, it's throwing off record cash.
But I have to play devil's advocate here.
Go for it.
Can they maintain this? What is stopping the legacy carriers, Delta, United American, from just aggressively mimicking this hybrid point-to-point model and crushing Southwest with their superior scale?
It's a fair question, but the legacy carriers are structurally incapable of mimicking this model efficiently.
Why?
They are burdened by massive, hyper-complex international networks that require the hub-and-spoke system to function.
Right, they have to feed the big international flights.
Exactly. They cannot easily pivot wide-body aircraft and international connecting banks into domestic point-to-point shuttles.
It's just a completely different logistical puzzle.
Furthermore, they are bound by deeply entrenched union contracts and legacy labor rules that make the kind of rapid, high-utilization ground operations Southwest relies on practically impossible.
The labor rules.
Yeah. The legacy carriers are aircraft carriers. They take miles to turn around. Southwest is a fleet of destroyers.
I love that analogy. Aircraft carriers versus destroyers.
Furthermore, Southwest is layering these highly optimized, idiosyncratic revenue streams on top of a financial foundation that is essentially a fortress.
Right. Let's quantify that fortress balance sheet, because that is where the margin of safety lies for the retail investor.
Definitely.
Tom Doxey noted they're sitting on $5.3 billion in pure liquidity.
$5.3 billion.
In the aviation sector, which is prone to sudden catastrophic shocks like global pandemics, terrorism, massive oil spikes, cash is literal oxygen.
It's the only thing that saves you.
Having $5.3 billion in liquidity means Southwest can effortlessly survive macroeconomic storms that would immediately bankrupt highly leveraged competitors or force them into punitive equity dilution.
Without breaking a sweat.
Doxey also mentioned their gross leverage ratio is sitting at a very healthy 2.1x, which actually improved from year-end 2025 despite all the macro volatility.
That's remarkable discipline.
And they generated over $2 billion in pure operating cash flow in just the first half of the year.
They aren't just surviving, they are aggressively compounding cash.
And that financial health translates directly to shareholder returns, right?
Oh, directly.
They aren't hoarding that cash in low-yield accounts. They have actively repurchased approximately $4 billion in shares over recent years.
Right. They are systematically reducing the share count.
Which structurally increases the ownership stake and future earnings power of every remaining shareholder.
Exactly. They continue to operate within incredibly strict, disciplined capital allocation guardrails.
So, bringing all the data points together, it is time for the final verdict.
Let's do it.
Looking at the record $8.7 billion in revenues, the flawless execution of the commercial pivot, the massive 30% growth in corporate travel, the fortress balance sheet, and the sheer inelasticity of consumer demand, despite a radically new pricing structure.
I think we agree on this one.
We are taking a definitive, unapologetic, bullish stance on Southwest Airlines.
Completely bullish. The investment thesis is remarkably clear.
Lay it out.
Southwest is no longer the quirky regional discount airline of the 1990s. They have evolved into a highly optimized, incredibly sophisticated commercial machine.
They really have grown up.
They proved they could slaughter their own 50-year-old brand identity, the free bags, and segment their pricing without breaking their legendary customer loyalty.
Which everyone thought was impossible.
Right. They have unlocked a massive, permanent new earnings floor that is entirely idiosyncratic. It belongs to them. It is not dependent on the macroeconomic cycle.
Which translates to highly durable earnings that can withstand intense external shocks.
Exactly. If you hold the stock, this Q2 earnings call is the definitive proof that the transformation is complete, the execution is sound, and the structural upgrades to the business model are permanent.
They changed the engine mid-flight, and the new engine is outperforming every metric on the board.
Beautifully said.
So as we wrap up this deep dive into the LUV transcript, I want to leave you with one final provocative thought to mull over.
Oh, I like this part.
If Southwest can successfully execute a pivot this massive, charging $1 billion in bag fees, reversing a decades-old corporate policy, and still growing their loyalty program by 35%.
What's next?
What is the next sacred cow of the airline industry that they might slaughter?
That is the million-dollar question.
Management dropped some incredibly subtle, easily missed hints on this call about future product evolution.
They did, specifically mentioning that they are actively looking into airport lounges.
Lounges. Southwest lounges. Could we see a Southwest premium cabin in the near future?
It's possible.
Could we see blocked middle seats? Or maybe the ultimate betrayal of the traditional low-cost model assigned seating?
Oh man, assigned seating would break the internet.
Right. But if they are successfully capturing 30% more corporate travelers, how long until they are forced to offer the premium amenities those specific travelers demand?
It's only a matter of time.
The very definition of a low-cost carrier is changing forever right before our eyes.
The boundaries between legacy carriers and hybrid carriers are completely blurring.
And Southwest is proving they have the pricing power, the operational discipline, and the brand equity to navigate that blur incredibly profitably.
They absolutely are.
Thank you for joining us on this Talk Tickers Deep Dive. Keep looking past the headlines, keep digging into the raw data, and we will see you next time.